Screen sharing. This meeting is being live streamed. Okay, got it. All right. Let's get our participants list over here. Let me get the chat window set up so we can see if there's any questions. All right. Need to start the recording here as well. I think that's how you do it. Oh, Lisa, are you going to record this, or could you give me permission and I'll record it?
And it's already being recorded. It's being recorded to YouTube, and we can take it down off there. We can download it from there if you need it.
Okay, because I've been recording them here local in case there's an issue.
Yeah, I don't know that we have a way to do both.
Yeah, if you give me permission, I can start the recording through Zoom.
No, I understand what you're saying. I can try, but all
right.
Let me see here. I can make you okay, I made you a co-host, so you should be able to record now.
All right. Okay, the recording's in progress. Okay, hello everybody, and welcome to the Foundry. Today we're going to be talking about backtesting and optimization. And this is going to be more of a technical presentation. We're going to be getting into a lot of concepts surrounding backtesting and optimization. Please, if you have any questions, ask, because odds are good someone else has the same question but is afraid to ask. So be the brave one and please ask. All right. Now, before we get going, of course, we have to keep the lawyers happy. So here we have all of our disclaimers. Keep this visible. There we go. So everything discussed in this presentation is for educational purposes only and does not constitute any form of financial or investment advice. Any decisions you make based on anything you see or hear during the presentation are made at your own risk and are yours and yours alone. Instead of reading the rest of this, I'll leave that to you guys. This is all the standard government disclaimers that we have to keep the lawyers happy. The bottom line of all this stuff is that trading is risky. So, don't trade using money that you cannot afford to lose. Now, before we get to the fun stuff, let's see where everybody stands on backtesting and optimization. For starters, how many folks out there actually have a trading plan? We're going to backtest and optimize. You got to have a trading plan. Okay.
I do.
Okay, so we have at least one person with a trading plan. Now, you're going to want to have a written trading plan when
Me
you're doing
too.
this, of course. Okay, so we got two at least. But you're going to have a written trading plan for this, and that will help you enormously when you're doing your back testing. Because when you're actually doing your back testing, you have to make sure that you are following your trading plan to the letter. Otherwise, your back testing of your trading plan will be worthless. So having a written trading plan goes a long way in helping with that. Now, basically, in a nutshell, your trading plan, it's going to contain the rules that govern how you will perform your trading. It's going to contain things like, how you're going to find your trades, how you plan your trades, entry stops, targets, money management, all that kind of stuff. Now, how many times have we heard or been told in the past that when you're trading, you should always follow your rules? How many times have we heard that? Nobody's heard that before?
Of course, we've heard that. Some people don't like to follow it because they get emotional, but hey.
Yes, well, is that good advice or is that bad advice?
From experience, it's good advice.
Okay. Most of the time, it'll be good advice. However, it's only good advice if your plan actually works, if your rules actually work. If your rules don't work, then following them is not a good thing. So how do you know that your rules work? How do you know that your trading plan works? How many people have actually tried to test their plans and find out if they work before they use them? This is part of what backtesting can be used for. So backtesting can be used to prove whether or not your plan works. And we're going to use it for some other things. Like, how many of you know how efficient your trading plan is? Is your trading plan actually capturing everything it can from the market? How much are you leaving on the table? Do you have any idea on that at all? Well, these are some of the things that we're going to try to answer, at least for the supply and demand trading methodology. How many here actually backtest? And what do folks think backtesting is? Anybody want to venture a guess? Okay. Everybody's sitting there thinking it's a trick question. Well, I'll just move on and give you the answer. Right. So wasn't a trick question, just trying to establish what folks know already. Try to tailor things to the audience. So
Maybe you can, Ripper, maybe you can just ask them to put their responses in the chat.
Okay. Yeah, if anybody wants to put their response in the chat, please feel free to do so. Although I've already given the answer here. But what is backtesting? Well, the fancy definition is that backtesting is the general method for seeing how well a strategy or model would have done ex post. Backtesting assesses the viability of a trading strategy by discovering how it would play out using historical data. If backtesting works, traders and analysts may have the confidence to employ it going forward. So, what is backtesting? Well, in other words, what we're going to do is we're going to take our trading system, we're going to feed it historical data, and we're going to examine the trades it produces. Simple as that conceptually. And this will give us the ability to measure the performance of our trading system. So backtesting is nothing more than a means to measure the performance of our trading system. That's it. Now, what is closely associated with backtesting is optimization. A lot of folks talk about optimization in the same breath as backtesting, and they're actually two separate things. Optimization, according to the online dictionary, is an act, process, or methodology of making something, such as a design, system, or decision, as fully perfect, functional, or effective as possible. So in other words, it's a method for improving our trading system. However, in order to optimize something, you need the ability to measure. Otherwise, you have no way of knowing if the changes you're making to optimize are actually improving the system or not. So backtesting gives us the ability to measure the performance of our trading system. And it is what makes it possible to optimize our trading system. So backtesting is the foundation, and optimization is built on top of that foundation. Now, there's a lot of different ways to backtest different systems, but there is a classic approach. Now, in the classic approach, you'll be looking at, a particular market interval that you trade. You're going to choose a period in the past, and you're going to feed what the market did in the past to your trading system, and then look at the trades that come out and how those trades perform. Now, the period we choose in the past is important, and there's different reasons why we may choose different periods in the past. We can choose a period where the market behavior is similar to what we're experiencing today. We could also choose a period where the market behavior is different, but it is something that we expect to see in the future. As an example of that, right now, there's a lot of people who think we're going into a bear market. That's different than what we've been seeing. So we may want to go and choose a period in the past where there was a bear market and use that for our test period and see how our system performed. And that can give us an idea of what to expect if we really do go into a bear market now. So mainly we'll be picking periods in the past because their behavior is similar to what we have now, or it's something that we expect to happen. We could also choose a period in the past because that period has something unique to it that we would like to test our trading system against. An example for that might be what happened on 9/11. There was an unprecedented event that nobody expected, and the markets got pretty wild. So it would be interesting to see how our systems would react if such a black swan event were to happen today. Now, black swan events, I'm assuming you're familiar with the term, but for those who are not, they are events that are very improbable, but which do occasionally happen in real life. So these are the main driving factors behind choosing the period in the past that we're going to use to test our system against. Now, how big a period of time do we actually choose to test against? We choose to test against a year, a month, a week, what? Well, a lot of that is going to depend on the trading system itself. If you're looking at a short-term trading system, then you may look at using shorter test periods. If you're looking at something that's designed to work over a longer period of time, then you may end up choosing a larger test period. But the other factor that we have to take into account is we want the test period to generate enough trades so that we have a statistically significant number of trades to look at. If it doesn't generate enough trades, then the results we get may not be statistically significant, and their value then becomes minimal. Now, what's a statistically significant number of trades? Most people say at least 30, with more being better. I've seen some folks who recommend 50 and some who even recommend 100. But a minimum of 30 is where you should start. Now, the classic backtesting approach, it treats your trading system as a black box. It doesn't know what's going on inside of that black box. It has no visibility to what the internal components are or how they work or what they do. It only tests the system as a whole. Historical data goes in and trades come out. Now, the performance of the trading system is usually measured in terms of monetary metrics. You'll look at the number of trades produced, and then you'll see what percentage of those actually made money. Typically, you'll look at things like how much money was made, how much money was lost, what the average win size was, the average loss, what the max win was, max loss. You may actually go and look at drawdowns and things like that as well. But we're looking mainly at financial metrics because we're gauging the performance of the system strictly based on the trades that are generated and how those trades do. So what are the advantages of this simple approach? Well, this should work with nearly any trading system out there. It doesn't care how your trading system works, what's in your trading system. As long as the historical data that your system needs is available, it can be fed into the system. We can look at the trades, see how well they did, and then calculate our monetary metrics. And those monetary metrics are, how we gauge the performance of the system. So it can generate data on the overall performance of just about any trading system, whatever one you want to test. And it can give you an indication of how your trading system should behave in different market conditions. And you do that by just changing, the test period that you're using for your backtesting. But what are the disadvantages of this approach? Well, you must have a relatively complete trading system before you can even employ this approach. So you're not going to be able to use this during trading system development. You're going to be able to use this only in the final stages when you have a relatively complete system put together. Because it's using black box testing, you can't easily isolate an internal component of your trading system. So this makes it difficult to measure the performance of individual components in your system. You could have one component in your system doing something that's detrimental, and that is masked by another component of the system, which is doing something beneficial. The only thing you know is what the end result is. And that makes a difference to optimize the performance of individual components in your system. It also makes it difficult to see how the different components in your system contribute to the overall success or failure, as the case may be, of your trading system. You could have components in your trading system that you don't need. You could have two components that are doing the same thing, and you only really need one of them, but you don't have a way to see that clearly. If you're going to try to figure that out, it has to be done through abstract, creative means. And the other thing is, it has no way to measure the efficiency of your trading system. And that's because it has no way to measure the theoretical maximum amount that can be made from your system So it can't figure out, based on what you're capturing, what percentage that is of what's available. You know, it doesn't know the market's putting down, let's say, 1,000 points on the table, and your system is only capturing 10% of that. It has no way of knowing that. So let's now talk about the general optimization approach, the classic optimization approach, since we're talking about classic methods here. So a trading system is going to consist of a set of rules or directives that tell the trader how to identify a potential trade and then actually go do it. Now, if we're going to go in and optimize a rule in the system, we're going to end up having to choose multiple historical test periods to use. And the reason we're going to be doing this is because we want to avoid something called curve fitting. Now, curve fitting, without getting into all the mathematical nonsense, you can think of curve fitting as over-optimization. Basically, you're optimizing your system so much that it only works well for the data set that you used for the optimization process. And this happens because the optimized system takes advantage of things which are unique to the data set being used and which may not occur regularly in other data sets. So your result ends up being tied to that one data set that you use to optimize with. So to avoid curve fitting, we're going to end up using multiple test periods. So if you're interested in, the performance based on how the market is doing now, you would choose several periods in the past where the market was behaving in a similar fashion to what it's doing now. And then you would test and optimize against each of these periods. And you would be looking for a result which works well across all of these test periods. And it may not be the best in any one test period, but it does well across all the test periods. And that's the kind of thing you're actually looking for. So once you've chosen your test periods, and again, these are the test periods that we're going to optimize against. So they're going to be selected based on market behaviors that we wish to optimize for. Then we're going to go and backtest our system against these test periods. We're backtesting our existing system because we want to get a performance baseline. We want to know, how are we doing right now? Because again, if we're going to optimize, we have to be able to compare. So we have to have a measurement of where we are now. And then after we optimize, we have to have a measurement of where the system is then, so that we can compare the two and see, did our attempts to optimize actually make things better? So we're going to start by making that baseline, getting the performance of our existing system on our different test periods. And then we're going to choose the rule that we wish to optimize. And we're going to hold everything constant except that one rule. Now, some rules, there may be a lot of possible values for. Other rules, there may only be a few values. In the supply and demand method, once you have found a pattern that's acceptable, there are several different ways that you can draw your zone based on the pattern that you've accepted. Since there's a limited number of ways that you can do that, you can just go and test them all. and see which one works best. That's the simple case. Now, there are other rules where you have a whole range of values that are possible. And testing every value is not a realistic option, if it's even possible. And so in that case, we have to do things a little differently. So what we're going to do is we're going to start by making small systematic changes to the rule being optimized. And then we're going to test those changes to see, did performance improve? So in the example here, we have rule X, we have a current value, and we're going to test a couple of values. Let's say it's a numeric value, so we'll test a couple of values above it. We'll test a couple of values below it. And we'll see what the results of those are. And let's say we find that when we increased the value, performance got better. When we decreased the value, performance got worse. Well, that tells us that we should start looking at higher values for rule X, because that is what improved performance. So we would continue increasing our value for rule X, testing it until we reach a point where the performance doesn't get any better, or we reach some kind of maximum limit on the value for rule X. So it's fairly straightforward. So the idea is we're going to look at our starting point, which is our current value. And we're going to look to either side of that current value to see which way improves performance. And then whichever way gives us better performance, we're going to move in that direction and continue to move in that direction until we reach a point where we can't go any further or where performance doesn't get any better. And this is going to be the normal case with most rules that you run into. So as an example, we'll look at an indicator that returns a value from 0 to 100. And let's say that the rule that we're looking to optimize looks for a value of 60 in order to give us a go or no-go signal on a trade that we're considering. So if we're going to optimize this, what are we going to do? We're going to, again, start by getting our baseline. What does our current system do? What's its performance? Then we'll test both increasing the value for the rule and decreasing it to see which improves performance. So we may pick, a couple of values below our current value, such as 50 and 55. And we'll pick some values above. We'll say 65 and 70 for the sake of this example. The actual values you're going to choose are going to depend on what the rule is and how sensitive that rule is, to a change in values. But the basic idea, again, is that we're going to choose some values above and some values below and try to find out which direction we have to move in order to improve performance. So when we do the back tests and we measure the performance of the system with the changed rules, if we see that increasing the value of the rule or increasing the value that the rule looks for improved performance, then we're going to continue in that direction. We're going to continue increasing that value until either performance doesn't improve or we reach the limit for that value. And of course, we may go the other way. You know, if decreasing the value improves the performance, then that's the direction we'll go in there. And again, we go to the point where either we've reached the limit or performance is no longer improving. Now, there are rare cases you can get into where going in both directions improves the performance. So maybe you somehow pick the worst possible value to have that rule look for. But it's rare, but it can happen. And so in that case, you can, again, continue going in each direction, finding out which gives you the best results. Or you can actually go and look at changing the rule so that you can eliminate this strange situation. And perhaps you have the rule look for more than one value. That's another alternative. Now you can end up doing a lot of back tests, you know, particularly if you have a lot of, you know, test periods picked out. And we will, of course, you know, who wants to do excess work, right? So we'd like to reduce the amount of back testing that can be done where we can. And one way that's often done is to limit the analysis to a small number of test periods. And then once you have candidates for optimal settings, you know, optimal values for your rules, for those test periods, you then go and expand the number of test periods to see if those values hold up. So this can reduce the amount of back testing that you have to do. Now, the fun really comes in when you want to start optimizing multiple rules in your trading system. And you're going to optimize each rule individually. Now, if you're lucky, your rules are not going to have interactions, in which case you can just optimize each rule individually and you're off and running. But sometimes you can have rules that actually interact with each other. And so what happens then is you optimize the first rule, you move on to the next one, you come up with an optimum value for the next rule using your optimum value for the first rule. And then you have to go back, now that you have a new optimum value for your second rule, and retest the first one, because the optimal value for the second rule interacts with the first one and may change what's optimal for the first one. So if you're in a situation where rule A affects rule B, or rule B affects rule A, you can get into a situation where you have to essentially, it's like going in a circle almost. You end up having to retest and re-optimize your existing ones that you've already done each time you optimize a new rule. And you end up going around and around like this until the values begin to stabilize. And so, you know, you optimize rule C, you go back to optimize rule A and rule B, and the values that you get for rule A and rule B don't change very much. And so at that point, you're starting to get stabilization in the values, in the optimal values you're getting for your rules. You know, and then you go bring in rule D, you go to optimize rule D using your optimal settings for rules A, B, and C. And then once you've got an optimal value for D, you then have to go back and retest A, B, and C. And again, you may have to go in a loop here until, again, the values stabilize and you don't get major changes anymore. So that means that fully optimizing your trading system can be a really major undertaking. So a lot's going to depend on your rules in your trading system and how much interaction there is between those rules. Hopefully, you'll have minimal interaction and you'll be in the simple case. So let's think about designing an alternative backtesting approach. Now, since we here support the supply and demand trading methodology, we're going to take advantage of that as we develop our backtesting method. Now, the approach we're developing is going to end up being specific to the supply and demand methodology. So what we're going to do is we're going to use white box testing instead of black box testing. This means that our testing process is going to be aware to some extent of what's going on inside of the trading system. And that is going to hopefully allow us to isolate and test individual components within the trading system. And that'll allow us to test and optimize components in the trading system individually. And this is interesting because we can potentially use it at this point for testing and optimizing the trading system as it is being built rather than after it is completed. So we can then actually allow the back testing and optimization to guide the development of the trading system. Now, of course, if we're doing this, we're going to have objective metrics to allow us to measure everything that's going on here appropriately. And so we're going to have to develop those as well as part of this alternative approach. And finally, we would like to be able to determine the efficiency of the trading system. We want to know how much of what the market is putting on the table we are actually able to capture and put in our pockets. And that can be very useful because we can sit there and look at our system. And if we see that the efficiency is very low, that means there's a lot to be gained by spending the time and effort to optimize it. If we find the efficiency is already very high, then it may not be worth the time or the effort to go in and optimize it because the returns on that effort are going to be relatively low. But without some way of determining the efficiency of our trading system, we have no way that we can actually figure that out. So this is something we would like to do. And with the supply and demand method, we can actually do this. Now, the supply and demand method, it has a focus on zones where we believe there is a significant imbalance between supply and demand. People often refer to that as unfilled orders. So our metrics are going to be, what's the right word? Directed towards that. And so we're going to have to make some assumptions here. For starters, we're only going to look at zones that are created during the test period. And that's because those are the only ones that we're going to have complete information about. Zones that were created prior to that, they're outside the window. We may see them, but we're not going to have complete information about them or what they did to them, or what they've been through before they got there. We're going to assume that we're going to take a trade on every zone. We're only going to enter a trade the first time the price returns to a zone. Now, zones may hold multiple times. You may get multiple bounces off them. But for our purposes here, we are interested in getting the biggest bounce that a zone has to offer. And the only way that we can ensure that we get that biggest bounce is if we get in at the very beginning, the first time that price returns to that zone. And to keep the numbers simple, all trades are going to consist of a single unit. Now, what's a single unit? Well, if you're doing futures, it's going to be what? It's going to be a contract, right? If you're doing stocks, you could do a single share. Or if you always trade in blocks of 100 shares, then you could make 100 shares as your basic unit. But we want to keep it simple. And by doing a single unit, then we can always take our results and scale them by increasing the number of units. And it keeps the numbers easy when you're doing these things. Now we're going to assume the simplest trading setup here. Entry is going to be the proximal line. Now, we say here that price breaks the proximal line. Why? Well, we want price to go one tick into the zone past the proximal line, because this ensures that if your entry was on the proximal line, you had to have been filled. If we don't do that, then you can get into situations where price came back to the proximal line, and in real life, you didn't get filled. Your order was there, but other people were ahead of you in the queue, and you didn't get filled. So by requiring price to break the proximal line by, one or more ticks, we're essentially saying that, you're guaranteed to have gotten filled at that point because price moved past the proximal line. All orders at the proximal line were filled. Now, similarly, we're going to have our stop one tick past the distal line. And so what we've done here is we have set up the width of the zone to be our risk. Now, given these assumptions, we're going to be looking for, or we're going to define here, as well as looking for this, but we're going to find the maximum bounce. When price bounces off a zone, the maximum bounce is the furthest point that price gets away from the proximal line of the zone. And this, of course, is before the test ends or before the zone gets broken. And it doesn't matter how many times price comes back to the zone. We just want to know what that maximum bounce is, because that is going to control how much money we can make off of that zone. And since we've set up the width of the zone to be what's at risk in a trade, we can then go and create a reward to risk ratio, where we'll take the maximum bounce off the zone and we can divide that by the width of the zone. And this will allow us to look at things in terms of the reward to risk ratio. And that's going to allow us to define what is a successful zone versus what is a failing zone. So for our purposes, and again, to keep things simple, we're going to say that a zone that produces a reward to risk ratio of 1 to 1 or better is a success. Does anybody have any questions on this? Is this making sense so far? Okay. Thank you, Hoy. So let's continue on. Let's look at metrics. So to judge the performance of our trading system, as well as the components that are in it, we're going to have to define appropriate metrics. And what we're going to be looking at is what we're calling the success rate. Now, the success rate, this is a term that appears in a couple of different contexts. For zones and bands, the success rate is the percent of the zones found during our test period, which were successful, which gave us reward to risk ratios of 1-to-1 or better. But you'll also see this term in regards to strategies, and there it's going to be the percent of trades which were profitable. So basically, it's always going to be a percent, and it's always going to be a percent of whatever we're looking at that succeeded. Now, here we're looking at how many points you can actually capture, at least in theory, off of a zone. And this gets back to the maximum bounce. And when we're doing a back test, we actually have a series of zones that we found. And the points available for capture is going to be how many points we can make off of that pool of zones that we found in our test period. So we're going to get this by adding up all of the maximum bounces for all of these successful zones, all the zones that gave us a better, than 1-to-1 bounce. And then we're going to subtract out the widths of all the failing zones. And this is going to give us the number of points that the market has put on the table for us to try to capture with our trading system. So this is known as the points available for capture. It's also known as the points in play. Now, the reason, of course, that we can actually calculate this, as well as the maximum bounces, is because we're doing a back test. And since we are dealing with historical data, everything is already known. So we can go through and we can actually see what the maximum bounce was. There's other forms of testing, particularly forward testing, where that's, not necessarily possible. So now that we know how many points are available for capture, we can actually look and see how many points our trading system did capture. And we can determine what percentage of the points in play was captured by our system, and that would be our trading system efficiency. So this is how we're going to measure the efficiency of our system at capturing points that the market has made available to us. Now, there's other metrics that may be useful. And these are more classic metrics, things like, the trades generated. How many trades did we actually generate during our test period? Points captured, of course. Average win size, average loss, max win, max loss, the usual stuff. And again, you can even go into drawdowns and all of that. But the unique ones are going to be the top ones here: the success rate, the points in play, the trading system efficiency. Let's take a step back for a moment, and let's go and look at the supply and demand trading methodology itself. So we're going to be looking at this from a very high level. There's a lot of variations of this that are being taught in different schools, in different places. But there are certain characteristics that they all have in common. In the supply and demand trading methodology, we attempt to identify those areas on the chart where supply and demand is out of balance, and we can prove it. And we're specifically looking at those areas where supply and demand are out of balance and are likely to remain so. And we make our money by the price movement that results when price returns to one of these areas that we have previously identified and bounces off that area. So we're looking for price to come in and reverse and then travel for some distance in the opposite direction from where it came. Now, we can break this process down into several phases. The first phase is where we find the areas on our chart where supply and demand are significantly out of balance. There's a bunch of different ways that people use to do this. There's candle patterns that people look for. There's something called volumetric analysis, which I saw claimed by a group on the web. I have no idea what volumetric analysis is, so I can't speak any further about it. You have other folks using order flow analysis. There's a bunch of different ways that people try to identify areas on the chart where supply and demand are out of balance. We're just going to lump them all together, and we're going to put them under a term called base isolation technique. Now, what is the base isolation technique? It's a set of rules for identifying areas on the chart where you have an imbalance, and these rules will often give you a way to gauge whether or not the imbalance is significant and what effect it might have on price movement. It also is typically going to tell you how to turn any significant imbalances found on the charts into a zone. And it's going to tell you how to draw that zone on your chart and where the boundaries are for that zone. So as in the diagram, market data goes in, your base isolation technique is going to examine it, and it's going to produce a pool of bands. This is the first phase. Now, the second phase in the supply and demand trading methodology is filtering. Some places they call this odds enhancers. There's lots of different names that people use for this, but in effect, it's filtering. What does a filter do? Filter basically removes things. If you have a water filter, it's removing stuff from the water. If you have an oil filter on your car, for instance, that's removing gunk from the oil, keeping it out of your engine. So in that sense, when we do filtering here, we're going to be taking our initial pool of bands, pool of zones, whichever term you prefer, and we're going to be passing that through the filter, and the filter is going to be rejecting some bands, and it's going to be letting others pass through. And the end result is a filtered pool of bands. And this should be smaller than the original pool of bands. And if the filter is doing a good job, the bands in the filtered pool should have a higher probability of giving us a good bounce, a 1-to-1 or better bounce. And when we go to phase 3, we're going to be starting out with our filtered pool of bands. And this is where we're going to apply our strategy. And the strategy will tell us which of the bands from our filtered pool to use. And it's going to generate an entry, a stop, and an exit technique. Now, entry and stop are fairly straightforward. We say a few things about exit techniques. There are various exit techniques that can be used. The most obvious ones are having a fixed target. You can choose a fixed target based on the reward to risk ratio. You can choose it based on a dollar amount, There are people who do it based on time in the trade. There's lots of different ways that you can do that. But you don't have to have a fixed target. You could use other trailing stops, for instance. Basically, this is where you move your stop order as price progresses. So once you're in the trade and price is moving in your favor, you're going to move your stop and have it follow price. Now, you may do that at a fixed distance, or you may do that as a percentage of price, or you may do that based on some percentage of what your profit is at that point in time. But you're going to be moving your stop and have it follow price. Another method that's often used is an indicator stop. And in this particular case, or excuse me, an indicator exit. But in this particular case, you're using some kind of an indicator to tell you when to exit the trade. So there's an indicator called parabolic SAR, which is often used for that. You could be using moving average crossovers, MACD, RSI. There's all sorts of different things that you could potentially use there. But the basic idea is that you are using some kind of an indicator to tell you when to exit the trade. So a strategy may be tied to a particular exit technique, or it may not be, in which case you may be able to substitute and change the exit technique associated with the strategy you're using. So the final phase, phase 4, is execution. And this is where we're actually going to place our orders and actually take the trade. And once we're in the trade, we expect to either exit with a profit, get stopped out, or we may not even get into the trade at all. We may not, the price may not come back and hit our entry. Or if it does, we may not get filled. All those are possible outcomes. But phase 4 is execution. Any questions? All right. So let's look at backtesting the supply and demand trading methodology. So we've already seen how there are several phases in this approach. And that allows us to break it up and test those phases independently. Now, there are some dependencies between the phases of the methodology, but the later phases are always dependent upon the earlier phases. So if we test and optimize the phases in order, we can treat them as if they were independent of each other. So for instance, phase 2, filtering, has a dependency on phase 1. But if we backtest and optimize phase 1 first, and we get the best possible pool of zones to start with, then we can hold that constant and test phase 2 independently of phase 1. Because at this point, we've got the best pool of zones that we're going to get, so there's no point in going back to phase 1 and messing with it. And similarly, phase 3 has a dependency on phase 2. It needs the filtered pool of zones. But if we optimize phase 2 before we move on to phase 3, then we can have the best possible filtered pool of zones. In which case we can hold that constant when we go to phase 3. And then we just concentrate on what's going on in phase 3. So by doing this, we can test the different phases as if they were independent of each other. We just have to do it in the proper order. And so this again just goes into the example I already gave. I got a little bit ahead of myself there. But again, the basic idea is we test and optimize phase one first so that we have the best set of, or the best pool of zones to start with. And then we can hold that constant while we play around with all sorts of different filters. And then once we found the best filters that give us the best filtered pool of zones, we can hold that constant while we go and play around with our strategies. And that allows us to, again, look at these things independently of each other without having to get into some kind of circular testing situation. This also allows us to be able to backtest and optimize our trading system as it is being built, since we don't need the complete trading system to begin backtesting. And that was one of our design goals. The other thing here is that testing and building our trading system in this way allows us to see how each phase of the system builds upon what came before to increase our chances of getting a good trade. And we can actually measure that. So this allows us to more thoroughly understand our trading system and to have confidence in it. And that makes it a lot easier to follow the system. A lot of so-called trader psychology problems are because traders do not have confidence in their system. They have not proven the system to themselves. They don't completely understand the system. So they don't understand why it should work necessarily. And it becomes very difficult to have faith in a system that you don't understand and that you haven't proven actually works. So building your system in this way and testing it in this way will increase your knowledge of your system, show you, prove to you that your system works. And you'll understand the system, you'll have confidence in it, and that'll make it a lot easier to stick to your rules and follow the system. And you need to be able to follow your system religiously in order to be able to succeed as a trader. So let's look at backtesting phase one. So of course, we're going to have to choose our historical period. Now, how many historical test periods we choose for a back test, this is opposed, to optimizing, just a back test. This is going to depend a lot on what it is we're actually trying to do here. Okay. For instance, if we just want to know how our system performed last month, okay, we choose last month as our back test period and off we go. And that'll tell us, how our system did last month. However, if we want a more complete understanding of how our system performs, we may choose multiple test periods, each one having different characteristics so that we can understand how our system actually is going to perform under different conditions. This will give us a more all-round picture of how our system works and how our system performs. And that can actually help us to be prepared for when market conditions change. So the number of back tests or the number of test periods for our back test is going to depend on what it is we're trying to learn about our trading system and how we are trying to measure its performance. So again, if we're looking for a more general picture of how the system performs, we'll be looking for multiple periods that potentially cover, current market type activity, or we may look at test periods for market behavior that we expect to see in the future, particularly in the near future. or we're just trying to get a more general understanding of how our system performs under different conditions. We could even just do a random sampling of past activity to see what happens. But these are the typical driving things that drive the choice of the number and type of test periods we'll choose for the back test. And now we're going to use our base isolation technique, and we're going to find all the zones during the test periods. Very straightforward. And then we're going to go and start calculating our metrics. So we're going to look for the maximum bounce that we get for each of the zones we found. We're going to calculate the reward to risk ratio. And then we're going to go and we're going to calculate the success rate and the points in play for the test periods. So at that point, we have measured the performance of the zones found by phase one of our trading system. So now we can look at that. We can analyze it if we want. We can decide whether or not we want to try to optimize it. So what might a back test result look like? This is a possible sample. So in this case here, this was for CL. For those not familiar with futures, that is the symbol for trading oil. We can see the test was for the month of August in 2018. And this was on a 60-minute chart. And we see that 48% of the zones found gave us a 1-to-1 or better bounce. And we actually have a breakout here showing us the bounces we actually got. This first table here is going to show us the zones that were broken by the end of the test period. So price came to these, it bounced off of it, eventually came back, broke the zone, traveled all the way through it. The second table is our runners. These are all the zones that price came back to and touched, but at the end of the test period, these zones had not been broken yet. So the values we have could improve. And so as we look here, we can see the first category, reward to risk of 0. These are our stop outs. These are all the ones that didn't make it to 1-to-1. And we can see that there were 13 here. And we can see that we would have lost 4.69 points. And oil is $1,000 a point, I believe. We can see we had 2 zones that gave us a bounce that was greater than 1-to-1, but less than 2-to-1. And for simplicity, we just calculate these as if they were both exactly 1-to-1. So the 0.89 points here, this is actually a conservative number, we'll call it. It's most likely lower than what was actually achieved. So by rounding down like this, we're building in some margin for error. Over here, we had a 13-to-1 winner. And that gave us 4.94 points. Our runners here, we had one that just got hit, but probably right near the end of the test and didn't have a chance to go anywhere yet. But then we had some others here. You know, we had a 1-to-1, a 3-to-1, a 9-to-1, 14 and a 16. And so we can see the points that would have been made from those, assuming that we could get out at the top of the max bounce. Now, of course, in practice, that's very difficult to do, but it is theoretically possible. And that's why I said earlier that this was theoretically the most that you could make off these zones, is the max bounce. So now that we have these, we can add these all up here, add up this column, and that's going to give us the points that are available to be captured. This is the points in play, what the market has put on the table that our trading system is trying to grab a piece of. So we can see here, even though we had 13 stop outs, there were still 18 points at $1,000 of points that was available that we could make. Let's look at optimizing phase one. Now, we discussed the general optimization approach earlier. And we've already shown that optimization and backtesting are actually two separate entities. Backtesting is measurement. So that means that we can use the general optimization technique with our new backtesting methodology. And that's exactly what we're going to do. So the primary metrics that we're going to be looking at is the success rate and the points available for capture, the points in play. And as we go through and we change our rules and we backtest and we look at the results of the changes, we're going to see changes that result in both the success rate and the points in play improving. Changes like that are pretty rare. They're generally worth keeping. We'll also see plenty of cases where changes are going to lower the success rate and the points in play. And those are, both undesirable outcomes. And so those are changes that we're going to ignore and get rid of. Most of the changes, you end up seeing either the success rate go up and the points in play go down, or vice versa. And those are changes that we need to examine carefully. In this particular case here, we've increased the success rate, but we have reduced the points in play. So what's likely happening is we're increasing the number of zones and bands that give us one-to-one or better bounces, but we're decreasing the overall potential earnings. And this is typically because we're finding fewer bands overall, fewer zones. The alternative, of course, is the case where we are actually increasing the points in play, but lowering the success rate. And in that particular case, we're typically finding more zones and bands. We're finding some bigger winners, but we also have a lot of little losers creeping in as well. Now, these last two cases, essentially what we're doing here is we are trading off points in play for a better success rate or vice versa. And whether those type of changes should be kept really depends upon the trader and their personality, and basically how well they deal with risk. You'll have a lot of folks, who prefer to take the safer approach, and they're willing to give up some potential earnings to get a higher success rate. And they feel more comfortable with that. They sleep better at night. That's their particular personality. And so they may be more interested in changes that increase the success rate. And as long as there's enough, points available for them to capture to keep them happy, that would be a successful or acceptable change to make. You have other folks who are interested in winning the big bucks. And so they're going to want to, optimize for the points in play. And they would be willing to sacrifice the success rate to some degree in order to get more points in play. And if they're capable of handling lower success rates, then they can do so. And they would gravitate toward changes that make that kind of a trade-off. So some of the changes that we make, whether we consider them successful or not, is going to depend on the personality and trading style of the trader. Now, by looking at different test periods, we can again avoid curve fitting. That's one of the things that we really need to do. We need to avoid over optimization. And by looking at different test periods, we can see whether or not the changes we've made consistently produce good results. We can also go and look at test periods that have different conditions than what we're currently looking at, different conditions that may exist in the market currently, to get an idea of how our system with these changes would hold up under alternative market conditions that we're likely to see. So this can give us an idea, again, of what to expect in the future from our trading system as market conditions change. Let's move on to phase two. Phase two was all about filtering. So in phase two, we're going to take our optimized pool of bands, our pool of zones from phase one. And we are going to filter that. So what's going to happen here? Well, we have our starting pool of bands. We already know what our success rate is and our points available for capture for this initial pool. We're then going to take the zones in this pool and we're going to pass them through our filter. And the filter is going to reject some and let others through. The ones that get let through are going to form a new pool of bands. And we can then go and measure the success rate and the points in play for the new pool of bands. We can then go and compare that against the success rate and the points in play from the original pool of bands. And we can see, did it improve? If it did, then the filter was a success. And we can actually go in and look at the change in the success rate and the points in play and use that as a measure of the performance for the filter. And we're going to call that delta SR for the change in the success rate, and delta PAFC for the change in the points available for capture, or the change in the points in play. And again, we can use this as our measure of the performance of the filter. We can then go and do this for all the filters we're interested in, and we'll have a measure of the performance of each filter. And then we can go and compare those and see which filter gave us the biggest improvement. So what might this look like? Well, we'll start with our original zone pool that we got from phase one. We can see here, again, 48% was our initial success rate, and there were 18.31 points available for capture. We then ran filter XYZ, and filter XYZ resulted in a smaller pool of bands. However, 58.82% of those bands gave us a 1-to-1 or better bounce. So that was an increase of 10.82 points in the success rate. We can see here where the changes were made by the filter. The filter got rid of 6 stop outs. Whoops. I guess I clicked too much there. So here we can see it got rid of 6 stop outs. We can also see it got rid of 1 successful zone. No filter is perfect. So there's always going to be unwanted side effects, but hopefully if the filter is good, the unwanted side effects will be minimal and will be small in comparison to the beneficial side effects. So by getting rid of 6 stop outs, our losses here were significantly reduced. And when we calculate the points in play, we find that we have 19 points in play now, 19.32. So our points in play actually went up. This means that the amount we saved by reducing our losses was greater than what we lost with the one winner. So we had a change in the points available for capture of 1.0192. And again, since this is oil, that amounts to more than $1,000. So filter XYZ was beneficial. So let's look at optimizing this. Well, we're going to have to obviously backtest every filter that's under consideration. We're going to have to measure its performance. And once we've done that, we're going to have the change in success rate and the change in the points in play for each of the filters that we're looking at. Now, some filters are adjustable. So we can go in and actually look at optimizing those filters. A lot of people like to use the RSI as a filter. And if they're going to go long, they want to see the RSI below 60. Is 60 the ideal number? Depends on the market and what the market's doing at that time. They could go in and optimize that now. Since you have a way to measure the performance of the filter, you can go in, change the filter, and see what the result is. So we could go in and look at changing that from 60 to 55. And then we can see what our change in the success rate and our change in the points in play are for our filtered band pool. And if we find that we don't get as large a change, then we'll try looking at values greater than 60. But either way, we now have a way to optimize the filter. And all I'm doing is I'm applying our general optimization approach and using the change in the success rate and the change in the points of play metric. And just like we saw before, changes which increase these two metrics are going to be generally desirable. Changes which reduce those are generally bad and should be avoided. And then changes which, trade off one against the other, that's going to be up to the trader and the trader's personality as to whether or not those are acceptable. So once we've gathered this information, the trader can go and evaluate his options and pick the filter that works best. Now, what about combinations of filters? Most of us will use more than one filter. Well, we can test that the same way that we test single filters. Since they're filters, we can just put them together. So as we see here, we can start with our, again, phase one optimized band pool. We can then just take the output of the first filter, feed it into the second, and so forth and so on for however many we want to combine together. And then look at what comes out, if anything, from the series of filters. And then we can measure the success rate and the points in play for the bands that make it into this final pool. And by comparing that with the success rate and the points in play, what we started with, we can see what kind of a change was made by all of these filters. And then that would give us the performance of the combination of filters. Now, why do you want to do it this way? Why can't we just sit there and add up the changes that we've calculated for the individual filters? Well, when you think about it, we could have filters that are eliminating the same bands. So if this first filter is eliminating all the same bands that the second filter would eliminate, then when the bands come through and out of the first filter and into the second filter is not going to do anything, because the ones it objects to have already been removed by the first filter. And that means that the second filter here is doing nothing for us. It's just extra work for no gain. See, and this is something that's hard to figure out with the traditional approach. But with this approach, we can zero in on that very quickly. So once we have the change in success rate and the change in points in play for the individual filters and the combinations of filters, we can then begin comparing them all. And we can pick, the filter or combination of filters that gives us the best results. Whether we're interested in optimizing for the best success rate or for the best points in play. And then, of course, we can go and look across our multiple test periods and choose the combination which gives us the most consistent results across all the test periods if we so desire. That may not give us the best results in any test period, but it may give us consistently good results across all test periods. And that's generally the one that most of us would choose. We can also figure out which filters or combinations of filters should be avoided, either because they don't do anything for us or because they throw out too many winners. So the trader can then go and choose the filters or combination of filters that match their personality and their goals and their trading plan. Does anybody have any questions on that? Was everybody able to follow that? Hopefully this is making sense to everybody. All right. I'll take the silence as a sign that everybody is with me or everybody's asleep. Yes, there's a lot to digest. That's very true, Hoy. Very true. And we still have more fun to go. So phase 3 is about strategy. When we backtest phase 3, we're essentially going to be measuring the performance of our strategy. Now, our strategy is going to tell us what zones we're going to use from our filtered pool of zones. It's going to tell us where to put our entry, where to put our stop, how to manage and exit the trade. So we're going to start with our filtered pool of zones from phase 2, because that should be our optimal set of zones to play with. So we're going to hold that constant as we go. So we're going to apply our strategy to our optimized pool of zones that we got from phase 2. And then, of course, we're going to calculate our metrics and perform our comparisons. Now, here we're going to be looking at things like how many trades were generated, how did those trades perform, what percentage of the trades were successful. Basically, we're going to be looking at the usual metrics for evaluating a trading system. These are all the monetary kind of metrics that we associated with the classic trading system. Or not classic trading system, but classic backtesting and optimization system. Now, the one that's different, of course, is when we start looking at what is the efficiency of the strategy. And this is the one that's unique to this backtesting methodology. And that's because in this methodology, we have the ability to determine what's theoretically possible. And then we can compare what we actually were able to get with what was theoretically possible. So that'll give us a way to, again, calculate the efficiency, and we can use that to compare strategies. We can also use that to optimize our strategy. So let's look at some results here. So we have from phase 2 our filtered band pool. And we can see here we have the success rate that we had before, the 58.82%. And we had the 19.32, we'll call it 33, rounded up, points in play. And so now we applied this strategy. We're going to call it ABC. And these are the results of that strategy. It picked 2 zones to trade, which happened to come out of our stop out category here. So that wasn't very good. And that cost us 0.77 points. It did take a 2-to-1. But what happened? The 2-to-1 wound up being a stop out. And we lost some more money there. It did take the 13-to-1. And it got 5-to-1 out of that. Out of the runners, it picked a 3-to-1. And that turned into a loser. It also picked the 9-to-1 and the 14-to-1, and both of those became 5-to-1 winners. So overall, it captured 2.5 points. That's $2,500. But we can see here the overall efficiency was only 13%. So we left the majority of the points on the table. Now, as we look at this, what can we tell? Well, can somebody tell me what kind of an exit strategy was used by strategy ABC or exit technique? Anybody want to venture a guess? Yes. Very good point, Hoy. Fixed targets limits the efficiency. And in this case, he was going for a fixed target of 5-1. So what happened here was, since he was looking for 5-1, when he picked the 2-1, that didn't make it to 5-1. That became a stop out and became a loser. Down here, the 3-1 that he picked, because he was shooting for 5-1, the 3-1 became a stop out as well. We can see the 13-1 that was picked here became a 5-1. 5-1 winner because that was his fixed target. We can see down here, the 9-1 and the 14-1 were also converted into 5-1s. So the choice of this strategy to use a fixed target of 5-1 resulted in trade-offs being made. And we saw that some bands, some zones that were considered successful became stop outs. In fact, everything below 5-1 became a stop out. And everything that was above 5-1 became a 5-1. So this is a consequence of using the fixed targets. Now, in phase 3, do we need to optimize our strategy? Well, if we look at the trading system efficiency, we can gauge the possible benefits. If the efficiency is already high, then efforts to go and improve it further may require a lot of work for minimal gain. So it may not be worth our time to do. But if the efficiency is very low, then efforts to optimize the strategy could yield large gains. There could be a lot of low-hanging fruit. And so, as we saw in the example, the efficiency was only 13%. So there's a lot to be gained potentially by optimizing the strategy. So what kind of things can we optimize in the strategy? Well, obviously, we can optimize what zones it selects, where it comes up with entries, where it puts your stops, and then the exit technique. So let's go and look at some of these. So we're going to use the same optimization approach we've been using all along. And we're going to look at the criteria in our strategy for choosing zones. And the metric we're going to focus on is the reward to risk ratio of the zones that are picked. So we're obviously like to avoid, the R0 category, because those were all stop outs. And we would like to pick as many of the high RR zones as we can get. So the metrics we're going to be looking at is the R ratios for the successful zones, how many selected zones were failures, and how many of the high risk to reward zones, or I should have said that backwards, how many high reward to risk zones were not selected. So we're going to go and play with our criteria, and we're going to look at the zones that were selected by the strategy. And we're going to look at the RR ratios of those zones to see which ones he's selecting. And we'll play with our criteria until we start seeing him select the better zones. What about optimizing entry points? Well, currently, we're using the proximal line for our entries, right? If we go in and we look at the successful bands, the successful zones in our pool that we can choose from, we can look at those and we can see how far does price penetrate those before it turns and gives us the expected move. If we find that most of those that we're interested in penetrate the zone a substantial distance before reversing and giving us the expected move, then we can consider moving our entry point from the proximal to a point within the zone. So in the first case over here, we find that a lot of the zones, when price returns to them, price does not penetrate very far before it reverses and leaves. And we can see that here, price only gets, a little way into the zone before it reverses and leaves. And we have a large number of, bands that this happens for. So in this case, we don't have very much room to move our entry point before we start losing large numbers of successful bands. But in the case on the right, if, with this group of bands or this band pool, we find that most of the zones are penetrated deeply before price reverses and gives us the expected move. And so with this particular group of bands, we can actually move our entry point from the proximal line, which would be over here, into the band without giving up many successful bands. So in this case here, we can reduce our risk by moving our entry point into the zone. Now, moving our entry point into the zone can reduce our risk, but it's also going to cause us to miss some successful trades. And we need to look at that and balance it. So if our entry point is now always going to be somewhere inside the zone, then on all of our stop outs, we're going to be losing less. Now, if we look at the winners that we are losing because we no longer make entry, because they don't come all the way into the zone where our where our entry is now placed, we can see how many points we're going to lose because we're missing entry on those successful zones. And we can calculate that and we can balance the two of them. And we can find out how far into the zone we can move our entry point and still be successful. Now, we can calculate this, or you could actually back test this. And if we're going to do this, the metric that we're going to be looking at is our trading system efficiency. And so if we move our entry point into the zone and our trading system efficiency improves, then that was a good change. If it goes down, then we're making less money. And so that may not be a change we want to make. We also need to look for other things that could happen, such as possible increase in volatility of our equity curve, drawdowns, things like that. But you can use our other financial metrics to deal with that. But for trying to figure out how far into the zone you can move your entry point, you're going to be looking at the trading system efficiency and seeing if you can get that to improve. Now let's look at optimizing stops. Currently, for purposes of backtesting, we're placing our stop one tick past the distal line. How can we figure out what might be an optimal value to use? Well, what constitutes optimal? That's going to depend on the trader and their appetite for risk, so to speak. But the case we're looking to deal with here is the ones where price returns to the zone and wicks through the zone by a little bit before turning and giving us the expected move. If we find that we have, several zones in our filtered pool of zones where this happens, we can go in and see how many ticks they violate the zone by. Now, we can sit there and move our stop further and further past the distal line and see how many of these zones we can convert from failing zones to successful zones. But what's the trade-off? The trade-off is, as we move our stop away from the distal line, we're making our zone effectively wider. We're increasing our risk, which means on our stop outs, we're going to lose more. So if we're going to do this, we have to pick up enough winners to cover the additional losses on our stop outs and to put additional money in our pocket to make it worth actually doing. And so we can actually look at calculating this. We're going to look at, the trades being generated by the strategy. And we're going to look at which of the failed trades would be turned into winning trades by moving our stop. And then we can determine the extra profit that comes from these new winning trades. And then for the remaining failed trades, we're going to have to look at what the additional losses would be. And then you can calculate the net gain, if there is any. That would be the new profits that you're gaining from the new zones that were converted from failing zones to winners. And then subtracting out the additional losses because we've increased our risk by moving our stop farther away from the distal line. And so you can repeat this process. You can do it in a spreadsheet, or we can actually back test it, whatever. But you can find the point where you're at the break even. Moving the stop farther doesn't get you any more winners. And you just start seeing, well, you don't see any more gain is what it comes down to. Your net gains starts getting decreased. And based on that, then you can set, how much wiggle room, as it's called in some places, basically how far to put your stop past the distal line of the zone. And again, you also have to take into account the max risk that the trader finds acceptable. You may find that the ideal point involves taking more risk than the trader is comfortable with. And so the trader then may settle for a lesser value than the optimal one. So is everybody able to follow that? Hopefully I explained that well enough. Now, if you don't want to calculate it, another way to do this would be to just repeatedly backtest while you move the stop. And you can come to the same result again. So depends on which way you're more comfortable with. Now, let's start thinking about our exits. We already saw earlier in one of the examples how our exit strategy limited our profits and how it turned potentially winning zones into stop outs and how it turned significant winners into much smaller winners. What did TradeStation just do? All right, that was interesting. So your exit strategy is very important, or your exit technique. It's part of your strategy. Now, if there's already a exit technique associated with your strategy, we can go and attempt to optimize that technique. We can go and we can look at whatever parameters, what rules that exit technique has. And just like we did with everything else, we can look at slowly changing those rules and measuring the results of our changes. And we can see what improvements we can get by changing different aspects of our exit technique. Now, when we're doing this, we're going to be looking at the trading system efficiency and the success rate for our trades. Those are the primary two things that we're going to be looking at. And again, just like with everything else we looked at, if you have a change that increases both of these metrics, it's generally a good change that you're probably going to want to keep. And if you make a change that drives down both the success rate and the efficiency, that's probably something to be thrown away. And when you get changes in the middle, where you're increasing one at the expense of the other, this again goes back to the personality of the trader and what the trader finds acceptable. And again, that gets back to their appetite for risk and how will they handle risk and things of that nature. but it's the same approach that we used before. And if you have several exit techniques available, again, you can do this with each exit technique and backtest it with the strategy to see what exit technique produces the best results. Now, in the example we had earlier, we saw we were using a fixed target of 5, R to R ratio of 5. And we saw how that limited our gains. So perhaps there, some kind of a trailing mechanism would work better. And that might be able to help us get a larger chunk of those big winners. And perhaps we could take some of the smaller winners that became stop outs because of our selection of a fixed target. We might even be able to get something out of those. But again, it's the same approach. You're going to take your exit technique. You're going to look at the rules for the exit technique, and you're going to go and optimize each of the rules. And make small changes, test the changes, see what the results are, see what works. And then you can compare the best results you get for each of the different exit techniques to see which exit technique that's available to you is going to give you the best results. And again, if you're developing your trading plan, you can use this as you develop it. You can use this to choose which exit technique you want to have in your trading plan. You can use this to optimize your entries and exits in your trading plan. And again, this will help you see how all the different pieces of your trading plan fit together and how they build upon each other to increase your chances of success. And at the same time, you're also proving your trading plan. And having that understanding and that proof that the trading plan works is going to give you a lot more confidence in it and make it a lot easier to follow what you have in your plan. So to summarize, the classic backtesting approach, it's a solid way to gauge the performance of your trading system. Been used all over the place for a long time. It's proven itself. It works with nearly any trading system, and it can give you an indication of how your trading system should perform, including earnings and success rate under various market conditions. The disadvantages to the classic approach is that you need a relatively complete trading system before you can apply it. And because it looks at your trading system as a black box that it can't see inside of, you can't use it easily to measure the performance of internal components of your system or optimize the performance of internal components in your trading system. It also has no way to gauge the efficiency of your trading system. Since it looks at your trading system as a black box and it doesn't know how it works or what's going on with it, it has no way to gauge what the theoretical maximum is that could be made, and no way then to determine how much of that theoretical maximum your system is actually capturing. So it can't measure your trading system efficiency. Now, the alternative that we presented here has a lot of advantages. As with the traditional system, it can give you an indication of how your system should perform, including earnings, success rate, under various conditions. But we are using white box testing. White box testing allows us to test and optimize internal components of the system. And this allows us to go and use it as you're developing your trading system. We also have the ability to measure the trading system's efficiency. But nothing's for free. So this particular approach only works for the supply and demand trading methodology. So that completes the formal presentation. At this point, we can have questions and answers. We can actually go look at backtest data. You know, what would you guys like to do? What kind of questions and answers, or excuse me, what kind of questions do you have? I'll try to provide the answers. Or is everybody just overwhelmed by the massive information that was just dumped on them? Yeah, there was a lot there to think about. It took us quite a while to develop that, actually. If you want to use your mics, go ahead. Yeah, might as well, Lisa.